streaming across the interwebs here. Good day to you, sir.
Good to see you, man.
My camera's delayed, so it's giving me a little trippy action over here. But we're back already. July OPEX is at hand. There's a lot of weird market movements. These are related to a lot of the topics around correlation and dispersion. Those are fancy words for stuff not moving in relation to each other, or a breakdown in norms, I would call it. So we've had that. Well, I'm not going to get into that, but we've had in other arenas and here in the life in the United States, but we're also having it in stock market. So, how are you doing? What's catching your eye here as the S&P slides a little bit lower? We have a wealth of topics. If you do have any questions, pop them into the chat. I actually got somebody on Bloomberg who weighed in or who lobbed over a couple questions as well. So we got a lot of topics to come up, but why don't you give us your little sort of state of the union? Let us know what you think is going on.
So, well, it's all about this. It's all about this big tech rotation, right? So, we had obviously massive leadership out of these big mega cap techs. We went crazy high in July with the strong seasonality, and that's come to an abrupt end. And you've got the kind of little catalyst coming in the form of not so friendly rhetoric out of Trump, who's looking more and more likely now. And he's saying, that he's going to kind of clamp down a little bit on big tech. Biden also potentially restricting exports for some of these semis to China. All of that is kind of triggering this unwind. And then you're seeing this monster short squeeze in Russell that you've been talking a lot about in terms of what's going on in the upside there. And just there's a big basically the pain trade, right? The pain trade seemed to be long, large cap tech, short the crap that didn't, the crap that's been underperforming. And we've seen the most shorted basket up like 20% in short order, basically, like the GS most shorted basket. So it's that pain trade that's playing out right now. But we are starting to see a little bit of a bounce in the likes of Nvidia, Tesla, Meta today. I mean, they're pretty unconvincing bounces given how much they've sold off. But I think we might be getting close to the end of this little route. I think earnings are going to matter a lot.
Yeah.
People are thinking these things were somewhat priced for perfection, and can they really deliver on enough earnings growth? The earnings growth has kind of been slowing, is projected to continue slowing, and there's still a lot of positioning in tech names, right? So is that going to need to reverse over after earnings are done and people kind of reevaluate? So that's the big story right now, but it does look a little oversold right now in tech. So I wouldn't be surprised to see a little bounce in tech. But obviously we've got earnings kicking off, right? Haven't we got Netflix after the bell?
Yeah, we had Taiwan Semi too. Taiwan Semi was interesting on the earnings perspective because last week they pre-announced, I don't know if it was a pre-announcement, but they announced revenues, which were very strong. And NVIDIA and Apple are major recipients of Taiwan Semi's products. And that really, if you remember last Wednesday, the market had a very bizarre rip, right? Remember that after, Powell was speaking to Congress at that time, but it was sort of a non-event. I'm speaking about this day here where this day in here where we really just kind of went bananas last week. And so they reported this morning. What's interesting about that is they're down. So they had great revenues, but sell the news, I guess, on the event. Netflix, to your point before. And for those of you who are having a hard time, Imran gives me a chance to plug our free earnings dashboard. If you go to resources and you go to free trading tools, we have the earnings dashboard up here. So you could bring that up. And so we could see Netflix, to Imran's point before, is indeed today, and it has a 7% implied move. Obviously, pretty good size implied move. We also have Tesla and Google next week. That's on the 23rd after the close. So that's the next big day coming up. I wanted to turn to today a little bit on this concept of dispersion and correlation, and we've been talking about this a lot. I'm curious as to your thoughts about it. Last week we had to sneak and move higher, right? Because Taiwan Semi came out. They're big suppliers. I mentioned NVIDIA and Apple. So NVIDIA and Apple were up substantially last week. And so you have NVIDIA, Apple, Microsoft are 20%, depending on the day, 21, 19, somewhere in that neighborhood of the S&P 500, and they're 25% of the NASDAQ. And so when those three names are up 4, 5, 6, 7% on a single day, or down, like Netflix was down 6% yesterday, that has a tremendous impact on the major indices, right? And this is the kind of correlation effect, or the concentration effect, I should say. It relates to correlation as well. Related to that is the fact that these names, NVIDIA in particular, Apple, massive options complexes, right? And so we were pointing to this, and I'd be curious to your thought here. I wanted to show this chart. If you caught the OPEX Effect podcast that we do with Jack and the guys at Excess Returns, we broke all this down for everybody. But this is the amount of zero, I call it zero DTE. That enrages some people. That's the volume that expires at the next Friday expiration. So zero DTE for single stocks is a lot faster to stay. But that's 55 to 60% of the volume of NVIDIA, Apple, Microsoft, and Tesla. So that's 50+% of the volume is for the next expiration, but less than 8% of the open interest is for the next expiration. Obviously, this is a monthly expiration, so the open interest for this Friday is a little bit bigger for those names. But basically, the point is there's a tremendous amount of day trading in these top three names. And so a lot of people talk about the options are, has more volume relative to stocks, and the options wag the dog. But now you have just pure day trading, and whatever the strategies may be, sophisticated HFT or retail or whatever it is, those people are day trading in these options. And those three names in particular have the biggest weight in the S&P 500. So you have this bizarre relationship now where 50+% of SPX volume is zero DTE. 50+% of these biggest three single stocks are zero DTE. And it makes you wonder, what the relationship or how the relationship in these flows are exacerbated. I mean, what do you kind of make of that? I know I'm sort of throwing a fastball at you as we get started.
Yeah,
here.
it's interesting, isn't it? It's basically saying that a large chunk of the day trading community has realized that, why am I day trading stocks when I can day trade options that give me way more convexity, basically, right? So that's the flipping where you buy the low delta options that they multiply by 3, 4, whatever, and then you lob them out. Yeah. So you've got, obviously that's quite an attractive proposition for day traders, right? Because they're going to get way more leverage to their money doing it that way.
Probably better margin as well.
Yeah, and then the flip side of that is you've also got a lot of appetite to do zero DTE premium selling as an income strategy, right? So you've got two potential use cases there that are quite attractive for people to trade daily options, and that is what's driving these massive increase in volumes.
Yeah, and those are excellent points. I mean, it makes sense, right? And the reason that I bring this up is because, in my view, options are leverage, right? I can buy a call, which gives me the rights to 100 shares of the stock rallies, or I can buy the stock at 100 shares. And obviously, the rub is the dealers and market makers have up to 100 shares of responsibility, right? And I think we all understand that at this point. So this relates to this other idea of concentration and liquidity, in that we showed this chart recently, and I apologize, it's probably a little hard to see here. Let me zoom in on this. I should learn the tools that I'm using to show everybody. So this is the top 10. This relates back to what we were just talking, but NVIDIA in particular, we talked about before. It's 7 or 8% of the NASDAQ, 7 or 8% of the S&P 500, 20+% of the XLK, 20+% of the SMH. And so what is the actual tradable float of, say, NVIDIA, right? I don't think it could be that large, because there's so many people that have to buy and hold those shares, in addition to hedge funds that just have big positions, or retail people that own the stock and are never selling it because they love the story, and, kudos to them. But when you have increasing day trading volumes and increasing options volumes, those in theory at some point have to be hedged with shares. Obviously, you can cap your risk with other offsetting options positions, blah, blah, blah. But I think generally when you have more options trading, you have more underlying shares that have to be bought or sold. And sometimes those shares may have to be aggressively bought or sold. And I've not found good data on this, but I wonder how much of the actual liquidity there is, right? Because it's pretty bizarre that you can see NVIDIA, which is a $3 trillion company, or at least it was as of a few days ago, it can move 5-6% on daily swings like it's nothing. Yesterday it was down, 6+%, right? So, these swings are unbelievable considering how big these companies are.
Yeah, that's a really good point. Like, you're right. and that can only be explained by the fact that the true free float of shares that is changing hands is much smaller, basically, right? So I mean, that statistic that I saw was the 5-day drop in the Mag 7 market cap was like over $1 trillion,
Yeah,
right, in 5 days. I mean, that's just an absurd amount of change in value, right? And that's the world we're living in. They're just adding zeros for fun right now, you know.
right.
So
A billion used to be a lot. Now $1 trillion is the new billion.
yeah, you don't get out of bed for like less than $1 trillion now.
I don't get out of bed for anything less than $1 billion either. Yeah. So this is moving around a lot. So what's interesting, also interesting, I keep saying interesting because there's so many fun things to talk about. Look at correlation move as you know, this really, it started with CPI last week and we moved into IWM and that tech started to get sold and people are flagging, oh, there's rumors of Taiwan and China. And I think because we're in OPEX now and positions are shifting and this correlation shifting, and vols moving up. And now that, you know, you take a little headline like, hey, China's going to invade Taiwan, which most people be like, whatever. And now all of a sudden that's why the market's moving. Well, no, markets are moving because we had VIX expiration, lost a bunch of positions there. There's a bunch of other positions that are also shifting here. And then these relationships are stretched like a band. Like you can't have a rubber band pulled back and just like bring the rubber band back gently. I don't think it works like that. Like you widen it out and it snaps back in. So correlation has made an unbelievable move up since Friday. As you can see here, this is 1 month correlation. And then you had mentioned earnings coming up. You always have some great insights on that. This is the dispersion index from SIBO. And if we zoom back on this was in our founder's note this morning, you could see dispersion index is moving really quite high. So why don't you help inform us or tell us, you know, how does this relate to the upcoming election, or excuse me, not election season, earnings season? Dispersion looks at 1 month options in this case.
Yeah, so I mean, typically you see implied correlation drop going into earnings because people hold on to their single stock vol and they're happy to sell index vol because they expect the stocks to go in different directions and have their big moves on their earnings, and the actual broader index isn't going to do too much, basically, right? I think it kind of got a bit overdone this time around. Like we were at record lows. I think implied correlation, like, as you showed it,
yeah, absolutely,
was a stupid number like 5. I mean, I've never seen it that low. Now it has been realizing low and it has bounced. That bounce is primarily just because we floated down to a higher index vol number. As we trade lower, as the S&P goes 100 points lower, and you ride along that S&P skew, you go to a higher implied vol on S&P. And because the S&P skew tends to be steeper than the single stock skew, that's why that correlation number bounces, basically, right? But it's still a very low number. And when it's a low number like that, what that suggests to me is that single stock vols are still pretty pumped relative to index, which means that when the earnings are announced, the amount of room that single stock vols have to come down, if they were to get anywhere near the index, and they're not going to go down to index levels, but what I mean is if the correlation level is going to bounce to a more normal level from this really record low, it means that like vol resets on single stocks could be quite dramatic this season. So if we don't get like 20% moves in the stock, like if we get like 5% moves in the names, you could be getting 20 vol resets in a lot of these names, basically, right? And that's what that. So I think call overwriting like a week ago, and this was, I was saying this to my entire community. I was saying, you know, any stocks that you own that have had amazing parabolic runs, you should be call overwriting on here, because you can sell more than 10% out of the money calls on really pump vols that capture earnings. And you're like, say, okay, if it rallies another 10% on earnings, I'll get taken out of my shares for a bit and I'll be a dip buyer. But I'm getting this juicy premium out of these calls, and the vol reset is going to be monstrous right after this, because the differential between index and single stock vol was so wide that's what it meant. It meant that vol's got a lot of room to come down.
It's an amazing point here, because this is from the SIBO. This is just a few days ago. This is single stock vol versus implied vol in the S&P on a 1 month basis. This chart only goes back to May 23. I believe in their note they said this is the highest ever reading that they got, the spread between those two. So that really backs up from a data perspective, which you had mentioned. And Option Butterfly Queen says we're adding zeros for fun. This is true, which is maybe segue into all these 13F filings that are popping up now. You had the funny one about Druckenmiller being long like 12 million IWM calls and it's really 12,000. And then there's the other guy, they're alleging that it's not it's only sort of funny because somebody was alleging that somebody bought, a billion DJT puts. Turns out it's off by many zeros. Anyways, let me segue back. So one of the questions we got here, I got it from over the Bloomberg chat, was about the VIX curve, which I know is a specialty of yours. And so sort of the question here is, despite the huge moves, I'm assuming they mean in the VIX curve structure is still upward sloping, even on the short end, indicating that things are calm in general. And so despite the low level of VIX, it's high compared to realized vol, which is a great point. And so which way do you think those are going to converge? Is the VIX going to go lower, or is realized vol going to go higher? Any views on that?
The only way I see like sustainable index realized volatility is if we get correlated moves through earnings, basically, right? So if we get all the tech names missing and the stocks just get a shoeing one after the other, then you're going to see quite a lot of realized vol in the index, basically, because there's such big heavyweights there, right? So I think to see sustained index realized, you need to see that. You need to see the heavyweights all kind of moving in the same direction, right? Now, because even if you get like one or two big moves on earnings to the downside, if the other names are having just as big moves to the upside, the index isn't going to do a lot, right? So I think that's a hard one to call, right? I mean, I do think we are, of all of the earnings seasons that we've had recently, this is potentially one where a lot of the names could disappoint, right? They've had a lot of hype into the whole AI excitement. And it's like, well, apart from NVIDIA, who's got the earnings, right? Who's got the earnings on the back of all this AI stuff?
Yeah.
Right? There's the promise of earnings, but there is no actual earnings yet, right? So obviously these companies make money in other ways, but like, have they priced in too much potential optimism right now? And is there going to be a bit of a delay in actually converting this stuff into real revenue? These are the questions that are going to be asked. And there's a few analysts and strategists out there that are getting a little bit more bearish on the AI story, saying that it looks a bit overdone, right? So that is your risk. And if that is true, and we'll know that in a couple of weeks when these names come out with their earnings, then you might see some sustained realized vol on the S&P to the downside, right?
You bring up some good points, and one of the things that does seem like a major risk is obviously it's the AI story and the chips that are related to that have really, I think, been the sole driver, I would say, I guess, of a lot of market upside. And so, there is a lot of risk there. And if that AI story breaks, then that correlation, all these correlation metrics we're looking at are going to really normalize, right? Because suddenly I think the generally correlation moves higher when the stock market goes down, right? And I think that's how things kind of normalize. This is 1 month realized vol here in green. Another thing is we came off of 5.8 realized vol is what we had last week. That's some of the lowest that we've had since pre-pandemic, right? So you end up at this floor where there's just nowhere else for realized vol to go, right? Like vol general is also short dated vol, at least was getting priced off of that as well. Zero DT options are pricing in 25, 30 bips of movement on a couple of days. So we're really just pushed inside of this box, and just naturally speaking, we had to sort of expand. One of the things that is interesting, though, to this person's question is, do you think that there's this knock-on effect from the VIX, where the VIX is just, and I think we've talked about the known unknowns and how you hedge that before, where there's not a lot of macro risk out there, I don't think. It's not like we're worried about a failing bank at the moment or whatever it may be. And so if you got to hedge the CPI number or this or that, you just buy the zero DT option or the short-dated option, right? So do you think that means that there should be that removes some of the fluctuations that we see in the VIX, at least the downside? I mean, do you think there's any relationship there to this person's point about the spread being very wide between VIX and
yeah, I agree that the introduction of zero DTE, the fact that people can trade it so liquidly in such monster size, and also that liquidity being there because people don't have to necessarily post as much margin. I don't know if they've addressed those margin issues, right? But there wasn't as much margin necessarily needed to post against selling zero DTEs. So I do think that has led to a bit less demand for VIX and a bit less demand for like the longer dated stuff. When I say longer dated, I mean like the 1 month protection. If people can use super short dated, they kind of often tend to. The only thing that changes that is if we see a risk that is a bit more systemic and a bit more, it's like it's not like a specific data point that people are trying to hedge, but it's like uncertainty. You don't really know.
A known unknown, I like to call it.
Like, you know, and that could, you know, we've obviously seen that political violence erupt. And if we had the threat of like civil unrest or whatever in the US in the lead up to the election, maybe that would be the uncertainty that the market would need to price on a macro level. But right now it hasn't really done that.
And I think too, with the French elections, I think there was a little sniff of that, right? That bled over in the US because you started to worry about the credit risk of certain entities over there due to the election. So that, or the March banking crisis with Silicon Valley Bank, right? We knew banks were in trouble, but we didn't know which ones. And how do you hedge that? To your point, you got to buy longer dated options.
And the US financials are roaring higher, right? There's clearly there's no fear about US banks right now, right? They've been ripping. So,
right. Yeah. And this chart here comes from Nomura, and this is the VIX beta to the S&P, and this is 0 percentile. So clearly the relationship here is not normal. And some of this could be related to, you know, the dispersion trade possibly, where you're selling S&P vol, and if it is tied to more shorter dated options, you know, that could be some of this effect. I mean, I don't know that I have a real, you know, axe to say this is specifically the reason why.
I think that beta, and that's something I track as well. I think what that does is that gives us a good gauge for like the street positioning, right? So normally in a normal market, you've got dealers getting taken short puts, getting given upside, right? And so as we rally, it's more of a grind, and vol goes down because they get sucked into all their long positions. If we sell off, they get taken short. That's quite a normal outcome, right? But when you hit a floor in vol, and you also get to a place where all these longs that the dealers have got, we go through all those strikes and they start to become downside, and they don't actually have any options at the money. And they might even be short some options that are far out of the money on the upside as well. That dynamic starts to change. And so you don't see like vol getting offered on the way up in S&P. Right. And we've seen that as we've been making new highs since we started breaking like 5,400 on the S&P. Every time we started making new highs on an aggressive up day, vol was bid. It wasn't offered, right? Fixed strike vol was higher, and it was showing you that actually it's not the same condition that we're used to, where dealers are long loads of upside and they're just rallying into that upside, and vol needs to break, VIX needs to break 12 and go to 10 and stuff like that. That just doesn't seem to be it. So that wherever that supply of upside was coming from, that was giving the dealers loads and loads of gamma on the upside, I think it's kind of changed. Like it used to be maybe 1 week to 1 month upside from institutions call overwriting, but I'm not sure it's like that anymore. Like maybe they're using really, really short dated, like 0 DTE type stuff to earn yield. But the minute we rally 50 bips, dealers haven't got any gamma anymore on the upside, right? So it's a very different condition. And I think it may well be, the culprit may well be 0 DTE being the kind of yield earning instrument of choice that is kind of changing that dynamic and changing the positioning landscape.
That's super interesting. And I was immediately thinking of this past week where you have VIX kind of in blue and the S&P up, and there was this weird, you know, spate of, you know, VIX up, market up, which generally, you know, links back to kind of short-term overbought conditions, I guess is how I'd say it. And, but the points on 0 DT are equally interesting. I want to real quick segue. I know a lot of you are looking for information on the call that Imran and I are going to do at 2:00. It's a private Zoom call. So if you're a SpotGamma member, obviously you already got that link. If you want the link and you're not a SpotGamma member, go to that link there. It's spotgamma.com/OPEX. You can also click the little QR code at the top. We give you a spreadsheet download of all the big options names that are expiring on Friday. And we're going to pitch a couple trade ideas as well, and take some questions in terms of like, give me some trades. So we'll be focusing on that in the 2:00 call. So scan the QR code to go over to that site, and you'll get a link to that Zoom call. So that's a quick segue on that. So tied back into this again, the last question that I thought was interesting from this Bloomberg question was the dispersion trade. The person jokes that their Uber driver knows what the dispersion trade is. Is that really that impactful? And looking at correlation, which when it finally picks up, is there going to be some dispersion trade liquidation? I don't know how big the dispersion trade is. I think it's, from what I've read about it and some estimates, I don't think it's not Volmageddon size in terms of like you had XIV, which was, this giant short complex. I don't know, maybe we could ping Noel from Convex about this, but do you have a handle on how big that trade is? And is it?
No, I don't know, because I'm not really in that space anymore. But like on the institutional side, but I would say, the levels of realized dispersion, I think, are being exaggerated by that trade, by how big that trade is. So I do think it's having impact, right? Just that, big positions do often have market impact like that, right? And it can go in the favor of that trade for a long, long time. Like, the only way it breaks is if a shock like a COVID occurred, where the index just needed to reprice quickly to the downside in a 5 to 10% like quick type scenario. That would create some serious pain in the dispersion trade, right? Because the index vol is where everyone would flock to, because that's the only thing that would have liquidity. That would spike massively, and the singles just wouldn't keep pace because they're already elevated relative to the index. So there is a pain trade there, but the problem with the pain trade is you don't know what's going to be the catalyst to trigger it, right? So there's no point like trying to go after that trade and just bleed money, because it's impossible to time. But it is a risk that you should be aware of. And if anything, it should be a reason why you don't want to be naked short downside tails, because it's just another driver that could really exacerbate a blow up on the downside. That's what I'd say.
I think I have nothing else to add. I think that was well said. And I would just say, generally speaking, and we just mentioned this before, that when correlation unwinds, it tends to be during periods where the market really declines sharply. And I think that the only way for the concentration of these 3-4 names and the semi sector as well, of just normalizing and breadth broadening out, you have to have these 3 names. They're more likely to come down, I think, as opposed to the rest of the market lifting up to match them in size, right? And so I just think that for this all to normalize, and for us who aren't, dispersion traders, to take advantage of this, you have to look at more equal weighted or stock plays that are based on breadth widening out. And I think, unfortunately, the only way this unwinds is for a risk off move where you have those bigger names come down, and there's such a big weight of the S&P 500 and the Qs that pushes them down a lot more relative to other names. So specifically, and we're going to talk about this shortly, I have been pitching in our subscriber notes long RSP, which is the equal weighted ETF for S&P 500 versus short spiders. And this is really a way of saying, hey, if this dispersion kind of correlation trade unwinds, or I call it the concentration trade as well, they're all kind of related in my mind. And or if the market breadth broadens out, then this equal weighted ETF may be a smooth way to play it. Say that again.
Are there options on that equal weighted one?
That's a good question. I don't know. I should have checked that.
Maybe a better way to play that, if you want to be short the spiders and long that as a relative value trade, the real reason you're doing it is because you think on the downside the spiders gets hit.
There are indeed options,
right? So maybe it's a put switch trade, right? Maybe I don't know what the vol is on that on the equal basket, but do you buy puts on SPY and then you sell puts on the equal weighted, right? And you do it that way. That might be a way of doing it.
Yeah, so I think that's the idea, and I don't know if I'm looking at this the right way here, but that's the sort of the general idea of things broadening out. So let's turn now on this topic of broadening out. I think that this has been hilarious, this move into IWMs. Yeah. The thing that struck me about the small cap sector is that it happened with SMCI. You remember that stock went from basically having a market cap of a couple of $100 to vaulting its way into the upper echelons, top tier of the stock market. And it just drove home this idea that, hey, once a company starts doing pretty well, they actually take it out of the IWMs and put it into a higher order index, right? And so by default then, and obviously, this is one of the things I think but then just when you see it happen, you go, oh yeah, if you actually perform pretty well, they remove you from the index. So it's like, it's always going to be kind of this I got loser index, I guess. I don't know.
It's negative. It's negative selection bias.
Yes, thank you. That's a great way to put it. And so, look, IWMs are up obviously a lot here in this past week. We were joking before about, Druckenmiller buying apparently 1.2 million calls. He didn't. And people are saying he has a 15% weight in his portfolio, which isn't true. But he bought a bunch of IWM calls. He's doing great. I've seen a lot of gain porn. Is that the word for it? I've heard of loss porn. I don't know if that is the other way around. Anyways, screenshots of people making a lot of money. Shout out to Matt Kors on that. He crushed it on this trade. So IWMs were up 12%. And from my perspective, if we look at skews here, and I think we'll talk about this in the 2 p.m. call, you had record IWM call. Like, this is like a mini GameStop is what I'm rolling up here. You had record call volume last week. It was like, I forget what it was, 2 million calls. I have it over here. And then if we look at skews, they've come down a little bit. But the problem for people who are long here, I mean, this is 1 month skew for IWMs. It's crazy, right? And this is in the delta space. So, they're very, very elevated, right? And so the problem here, when you have this call demand and then you have these moves, right? If you look at the distribution of returns here in IWM, the right tail's just been flexing on us, and that's very hard to sustain that. And the calls are getting so expensive that the odds of paying out, right, based on the returns that have happened in the last 5 days, those odds are diminishing. So you're buying very expensive options. And so if the move up starts to pause at all, that call skew, in my view, has got to collapse. So that looks like, hey, this is the 90-day range from our vol dashboard. This is how elevated we are. This is going to come down. That crushes call values. In theory, that means dealers are going to start selling stock or whatever it may be, but that really snuffs the move out or really suffocates the move to the upside. And so I said this on Tuesday that I thought that we were due for a pullback with the stock at 220. We obviously went to 224. And if you look at our founders note this morning, before I tee up fully, Imran, this 220 level is a very big level. This is the AM founders note here. You can see 220. I think this is where it holds for into tomorrow, and then I think we revisit 210 as call skew comes back. I've said a lot there, Imran, and you've been forced to listen to me there. What's your take here on the IWM space, both where it sits currently and how we look over the coming month or two?
I think it's a short squeeze. It's got short squeeze written all over it, right? So it's not that these companies are necessarily great companies. Some of them have got quite challenged balance sheets. I think they're getting excited at the idea that the Fed is going to turn and cut in September. September cut is fully priced. So they're giving them the benefit of the doubt and squeezing these names. But I just think once the short squeeze is done, they do their usual and drift back down. Like whether that's next week or it takes a little bit longer, that's a hard one to call. People are looking at these long-term charts and saying NASDAQ versus Russell, it's gone too far, it's a multi-decade highs and stuff. Yeah, but that's because the NASDAQ stocks make ridiculous amounts of money and they're taking over the world, right? So I don't know that. Yes, there's room for this short squeeze to go on a bit longer, but fundamentally, I'm not chasing these names higher. If you think it's pulling back next week post expiry on an elevated vol, then you're looking at some sort of put fly structure probably with the sweet spot at 210. That might look interesting because the vol is so elevated. And I agree with you on the call skew side. If that call skew does need to erode a little bit, then that in itself will create a negative Vanna effect and create selling of IWM, right? So that you might get that happen post expiry and be your little catalyst for a move back down.
Yeah, and the other part of this to the upside is there's very few positions, and this can change pretty quickly. But you see over 230, the positions really just drop. Orange being the call gamma bars, and so we're sort of just trying to, I think, set the stage for where are the positions, and then dig into skews and see where and how things are positioned. I've found that this is pretty effective in just saying nobody owns calls over 130, or the positions are just very small over 230. Excuse me. So. There's not a whole lot of reason as a sort of first principle to think that we can, that we'll move a lot higher. I also have been surprised by IWMs. I think if you're going to ask me, it's up 12%. And it's this beaten down sector. We're approaching all time highs again, and obviously these other broader markets are well through that. But just looking forward a little bit here, I don't really see a great reason for the market to sell off substantially. I think that we have so many charts, and I made a little Twitter thread kind of joking about this, where things are at records. Like we talked about the spread between index vol and S&P vol, VIX beta, and all this. So there's all these bizarre relationships, right, that are never seen before. And I do think that we need to have, and I've been calling it correlation spasm, just as my way to saying, like, we need these relationships to sort of sync back up and normalize, right? You've been in this business for a long time. I think that anytime we see markets that are doing weird things, that tends to not just normalize as we just start, soft landing to the upside. Do you sort of, first, do you have any agreement that things need to normalize, or can this persist for a lot longer? And if it does normalize, is that likely to do so to the downside?
Yeah, I mean, a lot of these vol metrics that we look at and stuff do tend to be mean reverting, right, in nature. So that's why when they get to extremes, we generally think of that as an opportunity. So the question we have to ask is it a complete shift in regime? Is it like, are the reasons why these relationships breaking down, are there structural factors that mean that they kind of can't go back the other way? I don't think so. I'd love to know your thoughts if there were some real game-changing things that mean that it is sort of going to be this way forever. But yeah, generally, having been in this game for 2 decades plus, yeah, these things
You're old.
I'm old, yeah. These things do tend to mean revert over time. It's just quite hard to know like the timing on that, basically.
Yeah, the timing is obviously the $1 million question, and the period that there's 2 periods that are parallel. I think a lot about 2021, and then obviously 2017 keeps coming up for a lot of reasons. We can show that in a minute. But in 2021, if you remember, we had Apple and Tesla splitting, and we had this incredible rally in August, for example, right? And then like the day that those stocks split, we had a really pretty good 7-8% drawdown in the S&P, and then we bounced back higher, right? And I think that if you look back at April of this year, it was a similar thing, right? Where all of a sudden, in the blink of an eye, S&P was down 5%, NVIDIA was down 20%, and then that was when people were worried about hot CPI and whatever else it may be, and then we rallied violently and kind of went back up. And I think that's part of like the normalization process here, where we have to have these spasms that the downside comes all at once, and then we kind of move back to the upside. And I think that for the next month or so, the election stuff maybe hopefully is more of a sideshow at the moment, I guess, before we start. I worry about the end of this year and some of the things that may happen. I mean, who knows? It's very hard to predict into the future. I just think that we're due for some small normalization, and then we kind of bounce higher.
Yeah, and I also think the macro story supports that, because whilst we might have 2 and a bit cuts priced in for this year, the speed of the cutting cycle can get more aggressive, right? If it needs to. So if there is any like wobble that gives the Fed the green light to be like, yeah, we're gonna start chopping rates down fast, market's gonna love that, right? I mean that reaction function of the market when more rate cuts get priced in, I mean that is not going anywhere, right? That is clearly still here to stay, and so I think there's plenty of room for faster rate cuts to get priced. Remember, we came in at the start of this year pricing in 6 or 7 cuts. They never materialized, and yet we still carried on rallying.
Great point.
Right? And if they suddenly do start actually delivering like 50 bip cuts in one meeting, the market's going to love that, and we'll be through 6,000 before you know it on S&P.
Yeah, and then I guess the question then turns, well, are we cutting because there's recession? So, this is the macro soft landing, this and that. We'll let the macro guys try to figure that out, I suppose. But to this point, we had 5550 as big support today in the S&P. I don't think this level gets busted. We may visit it Monday, Tuesday as OPEX is sort of cleaned up. But I personally would be looking to, see this general area as strong support. I also, we have a new beta model that we're working on, and in positioning, and it actually looks like there's a fair amount of positive gamma below 475 in the Qs, or at least gamma gets more positive. So I just don't see this set up for a giant flush outside of the fact that if you have the big three names normalize and come down, that's going to continue to weigh on the S&P, which is part of the reason that I was looking at RSP, and a couple of nice people in the chat here said liquidity is not great, but there are some options positions there to check out. I also wanted to talk about quickly just some of the bizarre behavior that we've seen in correlations while I have everyone's attention. We're going to wrap this up about 5 minutes. Again, if you want to join us for the 2 p.m. call, Imran and I are going to let our vocal cords rest here for a minute or two, about 10 minutes before that call starts. You can hit up this link, spotgamma.com/OPEX. You can hit the trading OPEX webinar link in the top. Any questions at all, info@spotgamma.com, and we'll get you sorted to make sure you get on that call. Anyways, back to my charts here. We debuted this chart. I have not found any other evidence of this. So pat myself on the back for this one, but this is number of days without a 2% one-day loss. I've seen it on Wall Street Journal and in some Schwab presentations, etc. We have now the longest streak, or second longest streak in the last 20 plus years outside of Volmageddon, right? The part that most other people don't then talk about is we also have the second largest, there's an asterisk, the second largest days without 2% one-day gain. We had one day in February that had a 2% gain because NVIDIA earnings blew it out. And to the point on upcoming earnings and this concentration risk, if NVIDIA just knocks the cover off the ball and triples revenue again, and the AI story gains a lot of steam, then why shouldn't all of these dynamics just get stretched back to all-time highs? I mean, why wouldn't they, right? And that's why these earnings, I think, are very important. If NVIDIA puts up some average numbers, that could really speak to a broadening out of equities, which I think would really weigh on NASDAQ and S&P as a whole. This is realized correlation. So I just looked at the correlation. I just want to show how crazy some of these moves are here. I'll try to zoom in. Whoa, too much, Brent. Don't. There we go. It's a little better. This is the rolling correlation of, you got IWMs here in blue, right? This is a negative correlation. So IWM with this recent move has become negatively correlated to the spiders over the last couple of weeks, something that, I mean, there's nothing else like it since 2020. It's just really very, very bizarre. And then what you also see here is, the reason I'm showing this is because SMH, which is the semi ETF, has actually started to move back in line with the S&P, right? If you remember back last OPEX, you can see the red line right here. NVIDIA was so call heavy, it was breaking away. Its correlation was breaking away from the market in an extreme way. It had the biggest single stock call position that we've seen since Tesla in 2021. NVIDIA had bigger call positions than the spiders. It was really bananas. And so, you're seeing the manifestation of these relationships, which I think it's just very hard to sustain, these types of moves. And you can see that, generally speaking, you have these, kind of spasms, and the market tends to, again, rectify this with I think a little bit of a sharp down move, which we seem to be kind of in the midst of here. So I think most of this, if you do have questions or are interested in more of this presentation, please check out the OPEX effect from excess returns. They're on your YouTube channel. You can also go to youtube.com/SpotGamma and watch a member Q&A where I went through all these dynamics last week as well. Imran, we're going to try to wrap this up now. So we have about 10 minutes before that OPEX call, where we're going to be going through a couple trade ideas. We field questions from that smaller group as well, so we can talk about trade structuring and important ideas into OPEX specifically. Anything else you want to add here before we wrap it up?
No, just like I say, be careful on the kind of downside tail risk, because there are things out there that can get nasty. But for me, if we zoom out and look at this tech correction, we're in a massive uptrend. We have been for ages. This is still in healthy correction territory. And so as long as you don't over leverage yourself, you can buy the dip safely in multiple ways, whether it's through buying stock in your long-term portfolio, like someone just said they did with NVIDIA, or whether it's restructuring smart option trades, like the things we're going to go through in the Zoom call.
Yeah, and I think I agree with that. I think there's a short-term risk of getting a little bit overdone, like short-term oversold, that kind of a la April, that dip probably gets bought And then if earnings are great, then we're easily going to go back to all sorts of charts that have never been seen before. So that's about that for us. Thank you all very much for joining us here today. Again, spotgamma.com/OPEX to get a link to that Zoom call we're doing in a few minutes, or you could scan that QR code. And Imran, we'll see you in a month, which these days feels like a couple of seconds.
Yeah.
Thanks so much for joining us. And how can people get a hold of you and see what you're up to?
Sure. So options_insight on X. And, you know, we post stuff on there. We do quite a lot of crypto stuff for those of you who are interested in crypto as well. And then options-insight.com is our website where you can come and check out our products.
Yeah, we didn't touch on Bitcoin, but obviously that one's making a lot of headlines recently. So maybe we'll talk about that in a few minutes.
Cool.
All right. Thanks so much, everybody.